If you save for retirement or you're close to retirement, 2026 brings several important changes you should know about. Today I'm going to talk through what changes from 2025 to 2026 for IRAs, 401ks and employer-sponsored plans, health savings accounts, and two important tax deductions that start or continue in 2026. My name is Spencer Ford, CEO and wealth advisor with Conservative Financial Solutions. I'm also a certified financial planner professional, and let's get into today's video. So first, let's talk about IRAs and Roth IRAs. In 2025, the maximum contribution was $7,000. If you were age 50 or older, you could add a $1,000 catch-up contribution for a total of $8,000. But starting in 2026, the IRA and Roth IRA contribution limit increases. The new base limit is $7,500. Now, if you're over the age of 50 or 50 or older, the catch-up amount increases to $1,100. That means your total possible IRA contribution in 2026 is $8,600. Remember, this is a combined limit across all traditional and Roth IRAs. So, if you have 8 Roth IRAs, then the total amount you can contribute across those 8 Roth IRAs is $8,600 if you're over the age of 50. You can't contribute $8,600 to each one. Now, let's move to employer-sponsored retirement plans. This includes things like 401ks, 403bs, most 457 plans, thrift savings plans, things of that nature. In 2025, the employee contribution limit was $23,500. In 2026, that limit increases to $24,500. Now, let's talk about catch-up contributions. If you're age 50 or older, you can contribute more. In 2026, the catch-up contribution for ages 50 through 59 and ages 64 and above is $8,000. That means many people over 50 can contribute up to $32,500 total to their employer-sponsored plan. Now, there is a special catch-up window if you are 60, 61, 62, or 63. You qualify for a larger catch-up, and that special catch-up amount is $11,250. So if you're those ages, and you have to be that age at the end of the year, the total possible contribution for 2026 is $35,750. So if you turn age 64 at the end of the year, you will not qualify for this. You have to be one of those ages by the end of the year, either 60, 61, 62, or 63. This is one of the biggest opportunities to boost retirement savings with those extra catch-up contributions right before retirement. Now, let's talk about health savings accounts. For 2025, the HSA, Health Savings Account contribution limit, was $4,300 for self-coverage only, and $8,550 for family coverage. Starting in 2026, those limits increase again. The 2026 HSA contribution limit is $4,400 for self-coverage only, and $8,750 for family coverage. If you are 55 or older, so remember I said 55, it's different from IRAs and Roth IRAs. If you're 55 or older, you can still contribute an additional $1,000 as an HSA catch-up. Remember, HSAs offer a rare tax advantage. You get the tax deduction for where you put the money in, for when you put the money in. You get a tax deduction when you put the money in. It grows tax-free, and as long as you take it out and use it for a qualified medical expense, you get to take it out tax-free too. You get the tax deduction when it goes in, and you get it tax-free when you take it out, as long as you use it for a qualified medical expense. And the great thing about an HSA account is if you take that with you into retirement and you're on Medicare, you can use it to pay for your Medicare premiums tax-free. Now, starting in 2026, you can deduct charitable contributions even if you don't itemize deductions. This is an above the line deduction. That means it reduces your income before calculating taxable income. So even if you take the standard deduction, qualified charitable giving can still lower your tax bill. This is a big change and opens the door for more taxpayers to benefit from charitable giving. That above the line limitation is $1,000 for single filers and $2,000 for married filing jointly. So previously, if you took the standard deduction and you gave charitably, you kind of missed out on the benefit of that charitable deduction being deducted from your taxable income. Now at least you get to recoup $1,000 or $2,000 of it if you are married filing jointly. The $1,000 is for single filers. So it's a really big benefit that you can take advantage of starting in 2026. Finally, let's talk about the senior deduction. This deduction continues in 2026. If you are 65 or older, you may qualify for an additional deduction of up to $6,000 per person. If both spouses are 65 or older, that can be up to $12,000 in deductions. However, this deduction does phase out. So for single filers, that phase out begins at $75,000 of modified adjusted gross income, and it's gone by roughly $175,000. So the phase out is between $75,000 and $175,000. For married couples filing jointly, that phase out begins at $150,000 of modified adjusted gross income and fully phases out at $250,000. This deduction is on top of the standard deduction and can significantly reduce taxable income for retirees. So when you're doing your tax planning for the year, if you're doing Roth conversions, if you're taking some capital gains, you may want to pay attention to those limitations so you can maximize that senior deduction. The takeaway is simple. 2026 allows you to save more for retirement. It can potentially allow you to deduct more, and you can plan more strategically. But these rules are layered and age specific and income dependent. And that's why planning matters. If you found this video helpful, please hit subscribe. Again, my name is Spencer Ford, and we'll see you in the next one.